You see the perfect setup. The price smashes through a key level. You jump in, you do the responsible thing, you set your stop loss, and then bam, you're out. Stopped out for a loss. But the real kick in the teeth? The second you're out, the price does a complete 180 and rockets exactly where you thought it would go. It seriously feels like the market's got your picture on a dartboard, right?
Well, here's the thing. It wasn't just bad luck. And I promise it's not personal. What you just experienced is a very specific and very much engineered event. You, my friend, were caught in a liquidity grab. And no, it's not some random fluke. It's a calculated move. And once you understand it, you'll never look at a chart the same way again.
So if it's a trap, that begs the question, why? Why does this even exist? Well, to get to the why, we need to meet the star of our show, a very, very hungry whale. In the trading world, we call the big players smart money. We're talking about the huge banks, the massive institutions, the hedge funds with pockets so deep they can literally shove the market around. For today, just think of them as giant whales swimming around in this big financial ocean. They're playing a totally different game than the rest of us.
Now, you'd think being a giant whale is all upside, but it comes with one massive problem. A paradox, really. If a whale wants to buy or sell a gigantic position, they can't just mash the button like we can. The sheer size of their order would send the price flying away from them before they could even get all their orders filled. It would be a terrible deal for them.
So how on earth do they solve this? They have to be sneaky. They need to find a place where a giant pile of opposite orders is just sitting there, waiting. In trading, we call that liquidity. Now, you and I, we think of our stop loss as a safety net, right? It's there to protect us. But to the whale, oh no. Your stop loss isn't a safety net. It's a big, beautiful jar of candy. And it's exactly what they need to get their huge orders filled without anyone noticing. And where is all this delicious candy conveniently located? Well, it's clustered together in the most predictable places you can imagine. You've got jars of buy-stop candy just sitting there right above recent obvious highs. And you've got jars of sell-stop candy waiting just below recent obvious lows. These are the liquidity pools, and you better believe the whale knows exactly where they are. Okay, so this brings us to the hunt itself. The whale knows where the candy is, but it doesn't just go for it. It sets a perfect, really sophisticated trap to get everyone to basically hand over their candy all at once. Let's break down how this works. The trap is this brilliant little two-step lure. First, the smart money algorithms will intentionally push the price just a little bit past an obvious high point on the chart, a level that everyone and their brother is watching. This one single move is incredibly efficient because it triggers a whole cascade of orders. So who exactly falls for this? Two groups. On one side, you've got the breakout traders. They see the price moving, they get that FOMO, that fear of missing out, and they jump in to buy. At the exact same time, you have the short sellers. They were betting the price would go down. So their stop losses, which are actually buy orders, get hit. Now they are forced to buy to get out of their losing trade. See what's happening? Suddenly you have a flood of people buying. And what does our hungry whale do with all these eager buyers? It says, "Thank you very much." It uses that sudden rush of buying to quietly sell its own massive position. It gets its orders filled at a great price. And then, once its business is done, splash! It slams the price hard in the opposite direction, leaving all those poor buyers completely trapped on the wrong side of the market. This pattern is so common, it actually has a few nicknames. One of the best ones is the Judas swing. Think about it, it's perfect. The market gives you this little kiss, this little sign of affection, making you think it loves you and is going your way, right before it betrays you. Okay, that's a lot, I know, but we know what the trap is and why it's there. So now, for the most important part, how to actually spot it. Because a whale that big, that powerful, it can't help but leave footprints all over the crime scene. So, your very first clue is the splash. And this is the big one. I want you to imagine an elephant jumping into a tiny little kiddie pool. It's not going to make a few gentle ripples, right? No way. It's going to cause a huge, undeniable wave. That's what the whale's entry into the market should look like. In our world, we call this powerful move displacement. So after the price grabs that liquidity, you don't want to see it just kind of drift down. You need to see a strong, energetic, and super obvious move in the other direction. We're talking big, powerful candles that scream conviction. This is the whale basically standing up and announcing, "I'm here." Now think about that elephant again. When it makes that huge splash, when the price moves with that much force and speed, it often leaves a little something behind.
It leaves a footprint right there on the chart, a tiny little imperfection in the price action. This footprint has a name. It's called a fair value gap, or just FVG for short. It's that little gap you'll see between the candles during that big, strong displacement move. And here's the cool part. This gap isn't just a clue that the whale was there. It's your secret weapon. It becomes an incredibly high probability spot for a potential trade entry.
All right, so we can spot the trap, we can see the footprints. Let's put it all together now. It's time to go from being the whale's lunch to swimming right alongside it. It's time to flip the script from being a victim to being an informed trader. Here it is, a simple 3-step plan. Step 1, and this is the hardest but most important part, you wait. Seriously, you do not chase that breakout. You just sit on your hands and you patiently wait for the price to poke above that old high and scoop up all that candy. Step 2, you watch. You're looking for your confirmation for that big, powerful displacement. And finally, step 3, you set your trap and you enter, but only if the price pulls back into that fair value gap. You see the difference? You're not chasing the whale anymore. You're waiting for it to come back to its footprint. 1, that's the number I want you to burn into your brain. It can feel like you need to learn 100 different complex strategies to succeed. But the truth is, just mastering this one powerful setup, really understanding the hunt for liquidity, can fundamentally change your entire trading career. So if you take anything away from this, let it be this. Stop chasing the market. Stop reacting to every little wiggle on the screen. The huge shift in thinking is to start acting like a hunter. You have to develop the patience to let the whale show its hand first. Once it reveals its real plan with that liquidity grab and that strong move away, then, and only then, is it time to act. And this is really the big secret. Those chaotic-looking lines on your chart, they're not nearly as random as they seem. The market is a highly efficient engineered machine, and its main job, its main purpose, is to move from one pool of liquidity to the next. Your job is to figure out where it's going and just hitch a ride. And that leaves us with one final thought. The next time you're watching your chart and you see the price creeping up to a nice, clean, obvious high, you're not going to see a breakout anymore, are you? No, you're going to see a potential trap. You're going to see the candy jar. So my question to you is, now that you can see the trap, how are you going to trade differently?